guys. Yes, so sorry for that bother. So basically, the workshop is going to be entitled The Basics of the Market, and this is Investment 101. It's going to be presented by me and Marwan Azan, who's representing Alpha Trading. So the types of investing, there are two main types of investors, the ones you hear about on the media. They are the retail investors and the institutional investors. The retail investors are the non-professional investors like me and you. They're the people who don't work for like these hedge funds, these big banks, these huge organizations. We're not paid professionals, unlike the institutional investors. They're also divided into like growth and value investors, which are subcategories. Growth people are the people who invest in these tech stocks, these like exciting industries, whereas value investors are the people who try to find things that are undervalued, things that they can make money off of, and things that they think the market is not pricing correctly. There's also, we have another subclass, which are the day traders. They're the people who get in and out of things every day. You have your swing and momentum traders. They're people who get into like a stock for like a week or two and sell off. And then your long-term investors, which are usually value investors or growth investors. And they plan to hold things for longer than, say, 3 months, sometimes 6 months, sometimes a year, even more. You hear of people like Warren Buffett holding for 2, 3 years. Warren Buffett even has shares of Coca-Cola going back to the 1960s. So yeah, that's a very long investment horizon. So the first thing is someone I saw actually talked about this on the WhatsApp group, the investment objectives. If you don't have an investing objective, then why are you investing? This is very true. So there are a couple of really main headlines on this. You have your capital preservation people. They're the people who say you have $1 million and you want to keep it at 1 million and try to make a little bit of money along the way. This is someone who is planning to preserve their capital and make just a little bit of gains on the side. You have your income investors, who are people who invest in like bonds and like things that pay off. They try to make a living off of investing. So they invest in things that hand out dividends, just to make a bit of money on the side. You have your growth investors, who are people who invest in these new and upcoming technologies, as well as these companies that aren't there yet. Like they're not fully grown, they're not fully mature. They want to make a lot of money down the line. You have people who are trading profits. They're basically a sort of growth investor who get in and out of things much more quickly than growth investors. So they just tend to make a bit of money and get out of the stock or the investment in large. You have your speculators, who are people who throw money on things that may or may not hit. They're very risky traders, and they tend to make the big bucks, like returning 10, 15, 20 times your money. And you have hedging, which is another investment objective. It's basically to remove risk off of other investments by mitigating it. So say you think the airline industry is going to do well, you buy a lot of airlines, but to cover yourself, you also end up buying a bit of car companies just to, hedge yourself. Hedge is basically mitigating risk. It's a way to get rid of risk. You can't get rid of risk completely, but you can do your best. Another thing that we're going to talk about is the banking sector. So banks are divided into the many different departments. The major ones are retail, which is the most common bank, the one that deals with clients, withdrawing your money, putting in money, saving account, credit cards, debit cards, things like that. They make most of their money off of interest. So say they charge you 3% for a loan, but they borrow it at 2.5, so they make 0.5% on the loan. Bank Audi, Chase Bank, Bank of America, these are all retail banks. Commercial banks are sort of usually combined with retail banks. They work with businesses mostly, and they work in a little bit more complex products. They support and they try to grow their clients. We also have credit unions, which are an alternative to commercial banks. We see these mostly in America. They're non-profit, actually. That's what differentiates them. So they don't try to make money, but instead they try to invest in things that have a community impact. Like say you need to open up a small ice cream shop, you go to a credit union, you get your loan, you open up the ice cream shop, but they make you like say host a Veterans Day event where you have to hand out free ice cream for like retired army members. They basically try to make a community impact. You have your central bank, which like Banque du Liban, it's the central banking authority of a nation. It sets monetary policy, which is like interest rates, and acts as a safeguard. So it's like a lender of last resort. And they also supervise and monitor private banks, so banks don't try to do some shady and illegal things. Investment banks, this is the most popular banking division we hear about in the media and the news. It's a very sophisticated division and it usually works on underwriting. So, underwriting is basically coming up with a new debt or equity instrument. Like they basically make new things to trade with. They facilitate mergers and acquisitions, which is a field that's very popular nowadays. Basically, if a company wants to merge with another company or buy another company, they go to an investment bank to get things like fairness opinions, they help with the deals, they try to make like the financial models and the predictions of the price and how much that company they want to buy is worth. They also act as a broker and they act as a market maker. So a broker is basically like a middleman and a market maker is basically like if you want to buy something and you can't find it, they're usually the one who like connects you to the source. You have Goldman Sachs, you have Bank of America's division of Merrill Lynch, you have JP Morgan, you have Credit Suisse. These are all investment banks. Sometimes investment banks also include things like corporate banking, which is a part of the investment banking division, and it works mostly with debt and credit, so loans and all those things, mergers and acquisitions. Sales and trading, S&T is the one you see in the movies where all the traders are screaming to one another and throwing around phones and things. You have your coverage groups, which are the people who do research on investments, and wealth management. Wealth management is divided into two types. You have your ultra high net worth people and your high net worth people. So if you have $1 million, you're considered high net worth. If you have over 25, you're considered ultra high net worth. The last thing I'm going to be talking about before I hand it off to Marwan, it's another definition sort of thing. I'm going to be talking about asset classes and some of their descriptions. So what are some asset classes? You have your equities, you have your fixed income, you have your funds, you have your forex, your crypto, and your derivatives. Equities are the stocks, they're the ones that are mentioned the most in the news, on CNBC, on Wall Street Journal, on all those news sources. They represent the market value of a company when traded. So that's the price of like Apple when you see it at 135, that's how much each share of Apple is worth. But they also refer to like accounting wise the value of the company when all its assets, so all the things it owns like cash, like buildings, like factories, are used and sold to pay down all its liabilities. So things like their debt, all those things. They're identified by tickers, which are 3 or 4 letter symbols. I'm going to talk about that in a bit. Some common stock exchanges you've heard of are the NYSE, the NASDAQ. The NYSE is the oldest one in the world. It has the widest range of companies. The NASDAQ is an electronic trading exchange. It's also pretty old. It got established in the 1970s. And it's home to more tech companies and biotech firms and all these internet companies, these new exciting companies. You have the LSE, which is the London Stock Exchange. You have the Euronext, which owns the Amsterdam and Paris stock exchanges, as well as a couple of others, and the Deutsche Börse, which is the German stock exchange. The thing is about the LSE that it also includes the Milan Stock Exchange, which is Italy's stock exchange as of 2018. So here you have a couple of examples of tickers. You have Amazon on your top and Apple to your right. You can see the closing price of the stock, which is the price of the last day. You have your daily performance, how much it's done today. So you can see like Apple is down 0.8 or 0.65%. 0.8 represents the dollar value. So it's down since open, like since the market opened, 80 cents, and it's down 0.65% if you want to look at it totally. You have your daily highs and lows, like you can see it was up to 122.86 and down all the way to 121.52. You can see the 52 highs and lows, which is the 1 year highs and lows. You can see it's traveled between like 137 and $52. You can see the market value, which is, sorry, the market cap, which is the entire value of Apple. You can see it at 2,090 billion and some ratios like price to earnings and price to book that Marwan will be explaining later on. The live trading, whenever the market trades, is actually 4:30 to 11 p.m. in Lebanese time. So it's 9:30 to 4 in America. And you can see things like volume, like bid and ask. So volumes, like if you've ever heard of volume, it's the amount of shares that change hands that day. So say I sold one share to Apple to you and you sold it to another person, the volume of Apple is 3. So that's how many times it's been changed. Liquid stocks, as referred to in the media, are the stocks that are traded in vast amounts. So you don't have a problem finding a buyer or a seller. Fixed income, which is the second asset class I'm going to talk about, they tend to pay a rate of return. So it's like those Euro bonds you've heard on TV where you buy the debt of a company or a corporation or a government, even multinational organizations like the UN sell you bonds. So you're basically loaning them money and making a little bit of money through interest. So you buy a bond for $100 that gives 3% per year. You make $3 every year until the end date of the bond where they pay you the whole $100. They serve different purposes. I mean, we've had war bonds historically, which are bonds used by the government to actually go into wars. So they may raise money to fight wars through bonds. And they have a contract that defines it. I have a couple of pictures. So this is a 3% bond that Australian government actually sold. Its currency is Australian dollars, and you can see all the contracts and all the details. It has a validity of September 2025. So you buy it and then you start earning interest every quarter. You can see it says 3% per annum paid quarterly. So that's 3% a year paid 4 times. So it's 0.75% every 3 months. And that's on the nominal value, which is for the people who haven't taken finance 210, that's basically the value of the bond that it's sold at, like the $100 that it's sold at, not the market value. So bonds can be trading for lower or higher depending on how much supply and demand there is, depending on some other things. You have your face value, which is the value I was talking about, the par value. It's also called that. You have your coupon rate, which is the 3%, the coupon dates, which is every 4 months because it's quarterly, the maturity date, the end date of the bond, which says September 2025. You have the issue price, which is 100, and the rating. See, each bond has a rating. You can see things like AAA, AA, A, triple B, double B, B, and so on and so forth. One interesting thing I'd like to talk about is the Lebanese Eurobonds we keep hearing on TV. Why they're called junk is because they're in default. So the Lebanese government was not able to pay the interest on the bonds. So they're currently rated as C in Moody's ratings or D in the S&P's ratings. And that means it's junk, it's in default, and they're going to be working on restructuring. So restructuring is basically a different way of paying down the debt. You start issuing new debt or try to make the maturity date longer or things like that. You try to work out something between the two parties. Another thing I'd like to talk about are funds. You probably hear a lot about funds, about money market funds, about mutual funds. So funds, you can imagine it as like a pool of money. So imagine like this giant pool and you have money in it. Basically, money market funds are a very short-term liquid fund. You buy it, you sell it really quickly. It's like holding cash, basically. Fixed income funds are funds that deal with like bonds, fixed income things that pay you an income. You have your specialty funds that focus on specific investments like military technologies or real estate or in companies that promote like human rights. So you can search for these on the internet. You have your index funds, which are very famous nowadays. And we hear about ETFs, which I'll talk about later. And they track a certain list and seek to replicate the performance. So like instead of buying the 500 companies in the S&P 500, you can buy an index fund, which is like a holdings company that holds 500 of these stocks and sells you part of them. So you're basically replicating the S&P. You also have your mutual funds, which are active funds. Like they buy and sell every day. They're active. They're not like a fund where you put your money, you park it in for like 5, 10 years. No, they usually are structured. They have a certain vision, like a contract, like a thing they want to do, an objective. And they take some expenses like the salaries for the managers from the money you make every year. You have your ETFs, which are super popular nowadays. They're a way that everyone's getting into the market. It's like a basket of a stock and other assets, and it diversifies you and it specializes you. Like you can specialize in a sector or diversify, like basically remove risk and try to incorporate many things. They're very safe. They're much more safe compared to like stocks, but they appreciate less. So it's a sort of risk to reward thing. The risk is lower, but the reward is obviously lower. They trade like stocks, they carry tickers and the same thing. I've put 2 examples. You have your JETs and your SPY. So the SPY, as I was previously saying, basically replicates the S&P 500. It holds 500 big companies like Apple, Microsoft, Tesla, Ford, all these big things. JETs is a specialized ETF. It holds airline companies solely. It holds JetBlue, Delta, United, or Air Canada. So if you think like airlines are going to make a push, they're undervalued right now because of COVID, but you think it's going to go back to a high price, instead of buying like United Airlines solely, you can buy JETs, which holds things like Air France, like Delta, like United as well, and Air Canada. So instead of buying a single airline, you can actually diversify your holdings and own smaller pieces of each one. Other funds you've probably heard of, and like you've heard of careers in these things, are private equity, hedge funds, and venture capital. So private equity is basically a partnership where they put a lot of money with their own capital, which is their own investment, or leverage, which is borrowing the bank's money to buy, and they try to boost the values of their holdings. So, say you want to buy your father's business or someone else's business, you buy the whole business, and then you try to boost the value, change the management, you try to put pressure on the people working there to do better, and then you hold it for a little while and exit it at a premium. So you try to say if you bought it 1 million, 5 years later, you work on it and now it's worth 2 million, you sell it and you pocket the 1 million difference. Venture capital is a subset of private equity. It's something that a lot of people are interested in, and we have an event actually very soon about venture capital. It's basically a way to invest in like these very risky startups at early funding stages. So basically, the app is like an idea, and then you want to invest in it and you want to grow with it. So when the company is like 2 years old instead of 10 years old, you basically go into venture capital. You have your hedge funds, which Marwan will talk about a lot later. And I'm sure you've all heard of the recent thing that happened with GameStop. So a hedge fund caters to only like the most sophisticated and wealthy investors. It's very risky and very aggressive, so it keeps on like selling and buying every day. And they're the people who try to make the big bucks, the huge profits. Book I like about hedge funds is More Money Than God. It's an awesome book, and I suggest everyone to read it if they're interested into hedge funds. You have Forex, which is something everyone probably hears. You can see billboards of it everywhere, you know, CFI and all those things. It's a currency trading market. So basically, it's a market where you have dollars and someone else has like euros and you trade. So that's Forex. It facilitates like operations, it helps international trade and business. Everyone pretty much uses Forex. Like when you travel to Turkey and you trade in your dollars to Turkish lira, that's basically Forex. You can utilize leverage a lot in Forex to amplify gains because currencies don't move like stocks. Like a huge move in currency is like 1% a day, whereas in stocks, they can move like 10% up or down, 15% up or down in one single day. So people use leverage. Say if you have $100, you borrow 900, so you have 1,000 now. You know, like you 10 times your money, you make 10 times the profit or 10 times the loss. You simultaneously buy and sell a currency, and they're listed as pairs. You can see like USD slash euros when you sell dollars and buy euro, so on and so forth. Cryptocurrency, another thing that's very popular nowadays. I have two examples of like Ripple, of Dogecoin, and obviously Bitcoin. Everyone has heard of them. They're a digital asset class. They're completely virtual and intangible. So it's not like money, it's not tied to anything. And they act as a sort of medium of exchange. So you basically, instead of go buying a car for $30,000, you pay in like one Bitcoin or half a Bitcoin or whatever. And they're very you then their main purpose is actually speculation and hedging. So speculation, as we previously mentioned, is like if you think something's going to go up there a lot, you buy a it, and hedging is like to remove risk. So cryptocurrencies, unlike fiat money is like dollars, like your Lebanese lira, they're called fiat. They have a fixed supply. So central banks, like the Lebanese central bank, which is Banque du Liban, can actually print money. You can't print cryptocurrency. Like Bitcoin has 21 million Bitcoins in fluctuation, and there can't be 22 million Bitcoins. You know, it's like set, the supply is fixed. And you can obtain them by performing certain tasks. That's called mining. They're very niche, they're not very popular, and they're illegal in a lot of parts of the world, like Lebanon. And they're very popular in being used in like these illicit activity markets, like things like drugs, things like terrorism. A lot of them use a lot of cryptocurrency, but it's being more and more adopted every day by people like you and I. The final asset class I'd like to talk about are derivatives. They're very complex, very risky, and very volatile. They hedge, like mitigate risk. They leverage, like you multiply your gains with them or multiply your losses. And they're used to speculate. So if you think something's going to go up and you don't necessarily want to buy it, you can use a derivative. They're called derivatives because they derive their value from another asset class, such as a currency or a stock. And they're the biggest market in the world. They're worth $14 trillion. And they have many categories such as warrants, such as exotic options, binaries, and these are all tiered into like levels which define risk. Like you have your level one options, which is pretty much the only one that we can actually access right now. Level twos and level threes are more reserved to like big investors, people who know what they're doing a lot. Options are the most common type of derivatives. They're divided into calls and puts. The call is basically a way to buy 100 shares of stock. You buy a contract that gives you the right to buy 100 shares of a stock or an ETF or whatever, and they have an expiry date and the price. There are also puts, which is the same thing, but it's for selling. So they give you a contract that allows you to sell 100 shares of a stock. Options can be bought or sold to open. So you can actually sell a call, which is like buying a put, if you think about it. I'll explain it later on, and Marwan has something about options as well. So when you sell options, you're basically the person who's writing the contract. Like, remember how I said a call is basically your right to buy. Selling a call is selling someone else the right to buy 100 shares of that. So you pocket something called a premium, which is the value of an option contract. I have it in a picture in the next slide. It's going to be very confusing. Options are some of the most confusing instruments that are traded. So here we can see to our left an MU call. MU stands for a company called Micron. They make a lot of chips, the things in your phones and whatever. You can see the Greeks. The Greeks are the way the option moves. So options aren't like stocks. They move using something called Greek symbols. You have your delta, your gamma, your theta, your vega, and your rho. So the delta is the most popular one. It's basically whenever the price of Micron as a stock goes up $1, you can see down below the share price is 45.76 in green. Whenever it goes up to like $46.76, the price of this, which is $0.57 or 57 cents, goes up by 0.45. So it becomes almost $1, like the contract. And every more dollar that it goes up, you have your gamma that keeps on going up as well. So gamma is basically what affects delta. So the next dollar it goes up, when it goes up from 46 to 47, your new delta becomes 0.23 plus 0.45. So it becomes 0.68. And if you remember your contract, which was first 0.57, went to $1, it's now 1.68 bucks. Open interest is how many unsettled options there are. So how many options still haven't found a buyer or a seller. And options, like we notice, have huge bid and ask spreads. Like you can see the bid is at 0.56 and the ask is at 58. So this one's a bad example of that. But most options usually have a difference between buyers and sellers. Your theta is your option decay per day. So every day that you hold this contract, your option value automatically goes on 11 cents. So tomorrow, this contract will be worth 0.57 minus 0.11. So it becomes worth 46 cents and so on and so forth. Vega is something that affects options a lot, and Marwan will explain that. That's basically what happened with GameStop. So IV, you have your implied volatility, which is how volatile the market thinks the option is going to be. So every 1% this volatility goes up, your Vega goes up by 1 cent or down 1 cent, depending if it goes down or up. And one thing about options is that people tend to see these values as cents, but you have to multiply everything by 100. So the price of this Micron call is not actually 0.57, it's $57 because an option is always at 100 shares and 100 ETFs. You know, it's like 100 units of a certain thing. And I hope everyone enjoyed my part. It was a little bit, boring and definition-wise, but Marwan will get into the more practical part. We can't teach you the practice without having the definitions and the key terms down. So I'll move it over to Marwan after the slide.
Okay, thank you, Aaron, a lot for these important definitions and terminologies. As you said, they are very important. Now let me share my screen. It's the same PowerPoint, basically. Part it's gonna be the most
Marwan, your content still hasn't started sharing. Okay, go ahead.
Okay, you can see it, right?
Okay. Yes, we can.
Okay, as I said, in this part we're gonna practical things, okay, practical stuff that you can use finish series. So we are aiming in this series in order when you finish this workshop, that will gonna give you're gonna have the information you need, okay, and the practical stuff you need to start trading right away. Okay, so first we're gonna talk like a small introduction on why we should learn how to trade stocks. So as you see here, 94% of the 10% wealthiest people in the world started off by trading stocks. Okay, so these people that we see down, Warren Buffett, Musk, Bill Gates, all these started off their journey to the top through trading stocks. So if you have a goal to reach to the top, you'll get, it's definitely stocks can be the good way to do that. Another thing to trade stocks is to multiply your capital and create a source of income. Okay, so imagine, guys, you work 30 or 40 years of your lives in a job in order to create, in order to have a big amount of money for retirement. Okay, so if you work 30 or 40 years of your life in that job, why don't you learn something which will take you 6 months or 1 year in order to double that amount or even triple it? Okay, and believe me, guys, it's very easy to double and triple the amount of money you have in the stock market, but at the same time it's very risky. So you have a risk to lose all of your money, and that's why you are here, guys, and that's why we are doing this workshop, because we want to learn how to trade stocks. So we want to make make money, we want to be profitable, we want to multiply, we want to double and triple the amount of money we have, and we want to avoid risks and avoid the risk of losing money. Now we're gonna here I'm gonna give you a small introduction to stocks of and companies. Okay, companies issue shares. Okay, so if I have a company, why I have to sell part of my company for people? So I'm gonna explain that through a small example. So imagine here you have a circle. Imagine this is my company or your company, which you are 100% owner, and it gives you a profit of $100K. Okay, now imagine I want to go okay, I want to open stores around Lebanon, let's say. Okay, now in order to do, need, let's say, $5 million, you know, expenses to open new stores around Lebanon. Okay, now if I want to get these $5 million, I'm gonna wait 50 years. I do $100K per year, so I have to wait 50 years to do 5 million. But a shortcut is to sell. Let's say I sold half of my company to investors for $5 million. Okay, so now as you see the other big circle, now I own 50% of my company. Okay, but I was able to buy these, able to expand and open these stores. So after I did that, now my company gives me $2 million per year instead of 100K per year. Now these 2 millions, half of them, so 1 million goes to the investors and 1 million go to me. Okay, so although I now own half of my company, but I get 10 times profit than before. Okay, so now here the numbers aren't accurate, okay, but it's a good and simple example for you to understand. And on the other hand, why investors buy stocks? Okay, so buy stocks also to participate in the growth of a certain company. So as you see here, the investors $5 million are now getting $1 million per year. Okay, so they're gonna have their money back in 5 years, and in the future they will get each year $1 million, and maybe we'll also have more. We're gonna expand more. Okay, so this is the main reason why investors, why me and you want to buy stock, in order to participate in the growth of a certain equity or and have profit. Now we have two types of companies, like how to buy stocks. Okay, buying and on the type of company. Okay, we have private companies and we have public companies. Now, private companies are difficult to buy stocks in and are not traded on exchanges. So it's basically an example. It's like a restaurant or a supermarket in your neighborhood. Okay, you can't just go inside and tell him, listen, I want to buy stocks in your company. Okay, he won't. On the other hand, public companies are easy to buy stocks and are traded on exchanges. It's like big companies that you know, Tesla, Apple, any company that you can contact your broker and buy stocks in, okay? IPO, which is the initial public offering, okay? This is the process where a private company goes to becomes a public company, okay? So let's say I want to take my company and I want my company to be traded on exchanges. Okay, what do? Is I call another company which are called underwriting firms. Okay, these companies are doing initial public offering, which is basically they offer shares for people. So as you see down in the picture, there is a company and an arrow giving stocks to some investors, and investors are paying money. So in this way, I get money from investors, and I can expand my company more and grow large. Okay, so this is basically the IPO. It's when the private company, sorry, becomes a public company. Now, players. What are the different players? Okay, so let's think about something, guys. Let's imagine we have a tournament of poker. Okay, so we're gonna make a game of poker. What differentiates the very advanced players from the very advanced poker player not only train himself to calculate probability and like that, but also knows how his opponent think, and also is like football clubs. Okay, so big football clubs that are very strong, for example, Barcelona, not only they train, they also, when they want to face, for example, the opponent, before they watch videos of their opponent playing. Okay, so you have to know who are the opponents. Now, what does that do with stocks? Now, the stock market, guys, is a zero-sum game. What do we mean by a zero-sum game? This means that every dollar you win, somebody have lost, and every dollar you lose, another one has won it. Okay, so it's like you're not alone. Okay, you're playing against other peoples who are also trading stocks. Okay, now we have to know who are the different players. Okay, so who are the people who trade stock? Now, Aaron mentioned them. I'm gonna mention them again, but fast. Are proprietary trading firms. Okay, we have investors, we have retail traders, we have mutual funds, and we have hedge funds. Proprietary trading firms are smart people. They look for inefficiencies. They basically the thing that I do when I trade, I look for inefficiencies. Okay, they also have advanced technologies and tools and have access to information. Okay, their effect on market is low. What do I mean by effect? I mean, you know, guys, when you buy a stock or something, its price will go up, and if you sell it, the price will. So their effect on the moving of prices is low. That's what I mean. Investors are long-term investors, like Warren Buffett, who buys something now and wait 50 years to sell it then later. Traders, guys, or I also call them gamblers. Okay, they are mostly dumb. They have no advanced tools. They have no strategies at all. Their effect on market is medium. And nowadays we are seeing a new phenomenon. The effect on market is becoming massive because like of social media, like what happened in GME and AMC stocks. So on social media, we call them meme stocks. So retail traders, their effect becomes massive. Okay. Now mutual funds, which are very important here, they have large capital. Okay, they have a moderate technology and it's easy to know their moves. Their effect on market, however, is very massive. Okay, so why it's very massive? Because as I said, they have. Okay, So when they buy a lot, and when they sell, that's something that many people fall in a trap. Okay, which like sometimes we hear that Facebook have good news. Okay, so we go and buy stocks, and suddenly the price go down, and we get upset, and we efficient, and we cannot predict what happened. But actually, you didn't see the different player who is mutual funds. These mutual funds tend to sell when they hear good news, and their effect is massive. And when they sell, they take the price down. So Facebook is owned by a big percentage of mutual funds. That's why sometimes when you hear good news about Facebook, prices go down. Okay, and similarly, hedge funds are like mutual funds. They have large capital, but they are smarter and hard to detect their moves. Their effect is also massive. Now, I want and I want to show you something on another website. Okay, so let's see. Okay, you can see it, right? Okay.
Yes.
Finviz.com to view the fundamental ratios of some companies. Okay, so and Finviz is also a screener. Now we're gonna talk in the future workshops. Okay, but let's hear okay, so let's see. So I want to show you this, the institutional ownership. What do I mean by institutional ownership? It's basically ownership are the big 80%, approximately 80% of the stocks of Facebook ownership. And what are institutional ownerships? Are like mutual funds, basically. So as you see, Facebook here is owned by a big portion of funds. Okay. So that's why, guys, when you go and buy Facebook, the price suddenly falls. Okay, because a big mutual funds. This is to just stay on institutional ownership. Now let me go to the slides. As you can see the slides, I'm that you have some problems.
Yes, Marwan, your internet connection seems to be lagging a little bit. Do you want me to open like a page or two? And you can just explain. I'll share my screen and you can just comment on that. So if you want me to open like Finviz, tell me.
Okay. Now it's good. Now you can see the point.
Yes, Marwan, it's better now.
Maybe because okay, so let us continue and we see okay, so we have also ways to make money in the stock market. Okay, is my voice lagging now?
It's much better now.
Okay, thank you. Okay, so we have ways to, what are the ways to make money in the stock market? Okay. So we have three ways basically to make money in the stock market. The first one is go or buying. The second one is short selling. And the third one is being flat. is longing or or buying. Okay, it's when you buy a stock on a low, a high price. I think all of us here know buying. Okay, so you buy a, say $10, you sell it at $15, and your profit is the difference. It's basically $5. It's very simple and easy. This is the idea of buying. What is short selling? Short selling, you can also, guys, make money when prices drop. Okay, so when prices drop, you can also make money short selling. Now, how does that work? It works by borrowing stocks and selling them at high price, buying them again at a lower price, and keeping the difference as a profit. So let me give you a small example. I know this is somehow complicated, but I will give you a small example to make it clear. Imagine Aaron bought a brand new iPhone for $1,000. Okay, so he bought an iPhone for $1,000, and I convinced him in a way or another to borrow that iPhone. Okay, so I borrowed from Aaron. I borrowed that iPhone and I sold it. I sold it right away. Okay, so I took it and I sold it right away for $1,000. So now I have $1,000 cash in my hand. Okay, now after 2 days, the price of iPhone dropped to $800. Now what did I do? I bought the same iPhone, but for $800, and I give it back to Aaron. Okay, now I'm left with $200 as profit in my hand. So this is basically short selling. Okay, so again, let me repeat it because I know it's complicated. So let me repeat it one more time. So Aaron bought an iPhone for $1,000. I borrowed from it. Okay, I sold it right away for $1,000. After 2 days, its price dropped to $800. I bought it again for $800. I give it back to Aaron. Okay, and I have $200 in profit in my hand. So what do you do? So if you know, guys, that this price of this stock is gonna fall down, okay, you go and you short it. And this way you can make money when the prices fall down. Okay, so this is basically the short selling. Now, as you see, so you say, now I want to search for someone to borrow his stocks. No, it's just one click. Okay, you just click, only one click, and that's the job of your broker, to find you stocks and give you to borrow. Okay, so it's just short selling. It's just one click. Okay, the only difference, you make money when prices go up and money when price. Okay, now why it's called shorting? Okay, as you see, guys, it's usually it's made for a short amount of time. Okay, because it's somehow dangerous. Why? Because when you short a stock, the best case scenario is that zero, but the worst case scenario, if it continues going to infinity. Okay, so that's why shorting is more dangerous than buying. So that's why it's called shorting, because usually it's done on a short amount of time. Okay, so this is basically short selling. Okay, now what is being flat that I added? Okay, now being flat is actually something that you can do. Being flat is just like not trading, simply not trading. Now, how can this make you money? You know, guys, if you are confused, if you are angry, if you are sad, depressed, anything, you should stay away from trading. Okay, why? Because when emotions interfere while you are trading, you're gonna lose you're gonna lose like accuracy and decision making. Okay, so that's why when you feel down, when you feel angry, even when you feel extra happy, avoid trading. Okay. A fun fact is that I never see a professional trader lose money unless from his emotions. Okay, so professional traders never lose money unless their emotions got in. So emotions is very important. That's why we have a workshop talking about that. Okay, because it can interfere with your decision making. Price prediction methods. So what are price prediction methods, guys? As you see, the stock market is all about predicting where the price will go. If the up, you long. If the price will go down, you short. But how are you gonna know if the price will go down? Through these price prediction methods. Now, the price prediction methods, we have two. We have technical analysis first, which is pattern analysis, trend analysis, support and resistance, indicator and tools, basically used for short-term trading. Now we have the workshop 3, we're gonna talk more about technical analysis in detail. Okay? So we're gonna learn a lot of things about technical analysis. We're gonna learn how to read, how to analyze patterns, how to analyze trend, resistance, and all of these. Now the other way is fundamental analysis, which is analyzing macroeconomics analysis, ratios, earnings, revenues, political environment, and fundamental reports like cash flows, balance sheet. Now, this is usually for long-term investing. Okay, I want to here make something clear that some people says that fundamental analysis were technical analysis don't, and another group of people says the technical analysis actually work and fundamental analysis don't work. But the real thing, guys, is that both work depending on your situation. Let's take this example. Imagine you want to buy a house. Okay, now you may have two goals. A house. Either you want to live in it 50 years with you and your family. Okay, if that is the case, you look at the infrastructure of the house, on the design, on the neighborhood, if it has a hospital around, if it has a school, for example, around it. Okay, so you're gonna take care of another goal from buying a house. Maybe you want to buy a house and sell it after 1 week. Okay, in this case, you won't look at all of these details about the prices of the houses that are being sold nearby and the volume, which is how many houses are bought and sell in the neighborhood. Okay, which is technical. We conclude that technical analysis is for short-term traders, okay, and fundamental analysis is for long-term. Okay, so both are very good methods to predict prices. Okay, but each work for your condition. Okay, the helpful resources that I used FinViz, which is a screener. As we saw, ratio, it shows you ratios of certain companies. We're gonna see more FinViz in the upcoming workshops. Okay, Investopedia is a good resource for general market knowledge and terminology. TradingView is for charting and like technical analysis. Okay, and also in the next workshops we're gonna use TradingView a lot. Okay, so therefore make register in order to view the next series of workshops, which will learn more things that are practical and that you can start working and trading right away. Okay, and I also want to say that if you want to know like information about trading, or you want to learn trading from A to Z, I offer 4 courses actually that teach you everything stock trading from A to Z, everything, fundamental analysis, technical analysis, everything, strategies, everything. So I'm gonna, after a while, I'm gonna number in the chat. I want to thank you a lot for watching this workshop, and please don't forget to register in order to view the next series of workshops. Okay, I'm gonna take your questions. Okay, if you have any questions, and I'm gonna also write my phone number in the chat box. If you want to know more details about my courses, you can contact me here.
Thanks everyone for attending. We hope you enjoyed it. Feel free to ask any questions. We're here to answer anything. And please don't forget to register on AUB-SYS 5077. And also you can join our WhatsApp group to stay up to date.
ساعات في عندك فانز بالشات كتير.
ايه عم بقرا، خزلوني كتير.
Okay, so we have a small question here. Do you know any app that's good for virtual trading for practice with fake money? Yes, you have TradingView. You can enter on TradingView and make a fake account, and you can trade virtual money easily. Okay, and you have also interactive brokers. You can make a account there. But I advise you to use TradingView first. It's very simple and easy.
We will try to include in the next workshop a slide about trading platforms that you can use in Lebanon for cryptocurrencies and also for stocks.